A complete guide to income tax in India, everything you need to know. Introduction to income tax. Income tax is a mandatory financial charge imposed by the government on individuals and entities based on their earnings. In India, income tax is governed by the Income Tax Act of 1961, which lays down the rules for tax collection, exemptions, and penalties. The tax collected is used for the development of the country, such as infrastructure, education, healthcare, and defense. Every individual earning beyond a certain threshold must pay tax as per the rules set by the government. Who should pay income tax? In India, every person earning an income must assess whether they are liable to pay tax. The tax applies to five categories. 1. Salaried individuals, employees who are working in companies, government jobs, etc. 2. Self employed individuals like financiers, consultants, business owners. 3. Corporations and firms, private limited companies, LLPs, partnerships. 4. Investors who earn income from stocks, real estate, mutual funds, etc. 5. Foreign nationals earning in India. The tax liability is determined based on total annual income and the applicable tax slabs. Sources of taxable income. The Indian Income Tax Act classifies taxable income to five categories. 1. Income from salaries like wages, allowances, bonuses, and benefits received from an employer. 2. Income from house property, rental income from owned properties. 3. Income from business or profession, profits earned from businesses, freelancing, or self employment. 4. Income from capital gains, profit from selling property, stocks, or other assets. 5. Income from other sources, interest from savings accounts, dividends, lottery winnings, etc. All these sources are added together to calculate the total taxable income. Income tax slabs for individuals. In India, tax is applied based on a progressive slab system, meaning that people with higher income pay a higher percentage of tax. As of the financial year 2023-24, there are two tax regimes. 1. Old tax regime, which includes deductions and exemptions. 2. New tax regime, which includes lower tax rates but fewer deductions. Old tax regime with deductions and exemptions, in which it includes income up to 2.5 lakh don't have to pay any tax, but from 2.5 lakh to 5 lakh they have to pay 5% of tax. From 5 lakh to 10 lakh, those who are earning from 5 lakh to 10 lakh have to pay 20% of the tax. Then those who are earning about 10 lakh has to pay 30% of tax. To tell more about new tax regime, which means lower rates, no exemptions. Income up to 2.5 lakh doesn't have to pay any tax, but from those who are earning from 2.5 lakh to 5 lakh, they have to pay 5% of the tax. From 5 lakh to 7.5 lakh have to pay 10% of the tax. From 7.5 lakh to 10 lakh have to pay 15% of tax. From 10 lakh to 12.5 lakh has to pay 20% of the tax. From 12.5 lakh to 15 lakh have to pay 25% of the tax. And those who are earning above 15 lakh has to pay 30% tax. Under both regimes, if your income is below 5 lakh, you can claim a rebate under section 87A and pay zero tax. Tax deductions and exemptions. Under the old tax regime, taxpayers can reduce their tax liability by claiming various deductions. Section 80C, up to 1.5 lakh deduction on investments like PPF, EPF, life insurance, tax saving, FDs, and ELSS funds. Section 80D, medical insurance premium deduction up to 25,000, 50,000 for senior citizens. Section 80E, deduction on interest paid on education loans. House rent allowance HRA, exemption on rent paid, applicable to salaried individuals living in rented houses. Standard deduction, 50,000 deduction for salaried employees. In the new tax regimes, most deductions are not available, but the tax rates are the lower. TDS, tax deducted at source. TDS is a mechanism where tax is deducted before income is credited. Employers deduct TDS from salaries, bank deduct TDS from FDS interest, tenants deduct TDS before paying rent. If applicable, if excess TDS is deducted, you can claim a refund while filing your tax return. How to file income tax returns. Filing an income tax return is a process where individuals report their income, deductions, and tax paid. Steps to file ITR online. Register on the income tax e-filing portal www.incometax.gov.in. Select the correct ITR form, ITR 1 for salaried individuals, ITR 4 for freelancers or businesses, etc. Enter income details from Form 16 and bank statements, etc. Claim deductions and exemptions under applicable sections. Calculate tax liability and pay any remaining tax. Verify and submit the return using Aadhaar, OTP, and digital signature. Deadline for filing ITR for individuals. The usual deadline for filing ITR is July 31st of the assessment year. If you miss the deadline, you may have to pay a penalty of up to 5,000 rupees. Advance tax and self assessment tax. If your total tax liability exceeds 10,000 in a year, you must pay advance tax in installments during the year. If you miss it, you may have to pay interest penalties. Tax refunds. If you have paid more tax due to TDS or advance tax than required, you can claim a tax refund. After filing ITR, the refund amount is credited to your bank account. Penalties for not paying tax. Failure to file ITR or under-reporting income can lead to late fees up to 5,000. Interest on unpaid tax, section 234A, 234B, 234C. Legal action in cases of fraud or tax evasion. Tax planning for saving money. To reduce tax liability, individuals can invest in PPF, ELSS funds, NSC, and life insurance under Section 80C. Buy health insurance for deduction under a Section 80D. Opt for HRA exemption if living in a rented house. Difference between tax evasion and tax avoidance. Tax evasion is illegally hiding income to avoid paying tax, which is punishable under law. Tax avoidance means using legal ways like deductions and exemptions to reduce the tax liability. Tax on investments, stocks, mutual funds, and property. Equity investments. If you sell stocks, mutual funds after 1 year, gains above 1 lakh are taxed at 10%. Fixed deposit. Interest earned is taxable as per your income slab. Real estate. Capital gains tax applies when selling property. Income tax for senior citizens. No tax for up to income 3 lakh for those who are above 60 years. No tax for income up to 5 lakh for those who are above 80 years. Future of income tax in India. The government continuously updates tax policies. The focus is on simplifying tax compliance and encouraging digital tax payments. Income tax is an essential responsibility for every earning individual in India. Understanding tax slabs, deductions, and filing procedures can help save money legally and avoid penalties. Proper tax planning ensures financial security while contributing to the nation's development.